Okay, let's talk about Social Security and Medicare changes. For those of you receiving benefits, you got a raise. It's called the Cost of Living Adjustment, COLA. That was 2.5%. Now, you got a raise, but you also have to pay more in Part B Medicare premiums. That went up from $174 to $185. For those of you who have high income, and this is considered $106,000 for a single person, $212,000 for a joint person, you will hit the first line at which the government makes you pay more for Medicare Part B. It's called Income Related Monthly Adjustment Amount, or IRMA is the acronym. The first IRMA line is at those two thresholds I gave you, 106 and 212 for joint, and there are multiple thresholds, and your Part B premium will climb at each of those thresholds. For those of you who are working and paying into Social Security, you pay 6.2% and your employer pays 6.2%. That combined is what goes in to help create and justify your Social Security income in retirement. You only have to pay that 6.2% Social Security tax on the first $176,000 of income. I say only, but in reality, that's a good amount of income. But after that line, $176,100, after that line, you do not have to pay the 6.2% Social Security tax for the rest of the year. When January 1 rolls around again, you'll begin to pay that tax again until you reach the threshold once more. Okay, we're going to talk about some retirement contribution changes, both the amounts you can put in and various income limits for contribution eligibility and deductibility. For regular IRAs and Roth IRAs, they call them traditional and Roth IRAs, the limits haven't changed. It's still $7,000 for a regular contribution, or an extra $1,000 for those of you over 50 years old. That's called a catch-up contribution. For 401ks, 403bs, 457s, thrift savings plans, all of these retirement plans, the contribution limit is $23,500. That's about $500 more. The standard catch-up is still $7,500, but the next part is brand new. We've never seen this happen like this before, where they picked 4 specific ages: 60, 61, 62, and 63. If you are one of those 4 ages, your catch-up limit is actually $11,250. Again, that's brand new for 2025. And if you're trying to figure out, okay, where do I land and how do I contribute to my 401k? What should I do? Of course, our advisor can help you walk through these lines and the ages and the numbers and ensure that you're contributing the max if that's your goal. Okay, there are income limits for contributions to IRAs. For a regular IRA, they will give you a tax deduction. A traditional IRA, you'll get a tax deduction for that contribution because you're turning it into pre-tax money. However, if you make too much, they don't give you that deduction. That line is quite variable based on whether or not you have a 401k or a retirement plan at work, and whether or not your spouse has a plan at work. So we won't go through that whole table. That's another item that we're happy to help you with. But just be aware you get a deduction if you're under certain lines. For a Roth IRA, it's a little bit different. They don't give you a deduction because that's after-tax money that you hope will grow tax-free forever. There's not a deduction line, there's just a contribution eligibility line. So if you make too much, you cannot contribute at all to a Roth IRA. And those income limits have gone up a little bit. They are now $165,000 for a single person and $246,000 for married filing jointly. And then lastly, it's all the way down at $10,000 for married filing separately. It's one of those areas where it really is painful on the married filing separately situation. Okay, let's talk about HSAs. This is an account that you put money in to save for future medical expenses. You get to put it in tax-free, and if you use it for medical expenses, you get to take it out tax-free. And the limit of how much you can put into these accounts has gone up a little bit. So for an individual, it's $4,300. For a family, it's $8,550. And then there is a catch-up of $1,000. Now, I'm going to pause us for a moment here because the catch-up age is 55 for an HSA. The catch-up age for IRAs and 401ks, that's all 50. That's an important difference. Don't do the catch-up to your HSA before you reach 55. And then remember, there's another catch here. The match. If your employer is giving you, let's say, $1,500 towards your HSA, that needs to be included as part of your maximum contribution limit. That doesn't work like that for a 401k. The match into a 401k does not go towards your $23,000 and change that you can put in. It does go towards your individual or family contribution limit for an HSA. So that key distinction is super important so that you don't accidentally over-contribute to your HSA.